we look at proposition of incorporating the corporate tax. So that should be now our subtopic, proposition of incorporating the corporate tax. So when the corporate tax was incorporated, we want to know how M was able to get the value for the firm, and also how to get the cost of equity for that. So we cannot something brief on that area. We can summarize that. When incorporated the corporate tax, when incorporated the corporate tax, they argued that the levered or geared firm, they argued that the levered or the geared firm, will enjoy, the geared or the levered firm will enjoy the interest tax benefit, which is equal to interest expenses, multiplied by the tax rate, which is equal to interest expenses multiplied by the tax rate, Therefore, they argued that the value of the firm, would be affected. The value of the firm will be affected with the increase in the leverage. The value of the firm will be affected with increase in the leverage. It will be affected with the increase in leverage. Another paragraph, we note that the cost of equity, of the levered firm, given the cost of equity of unlevered firm, would be expressed as follows. Given the cost of equity of unlevered firm would be expressed as follows. So if you want to compute cost of equity for the levered firm, it will be given by cost of equity of unlevered firm, then in the brackets, cost of equity for unlevered firm, then also KD, then D over E, then 1 minus the tax rate like that. So to compute our KEL, we shall be having KEU, then we add in brackets KEU minus KD, then D over E, then 1 minus the tax rate. So that formula, we get it from the last diagram we drew under the net operating income theory. When you check the diagram we drew for the net operating income theory, I was able to give you those details. Those particular details. So, are you able to see that information? So when you express it, you will now be able to come up with how to get KEL. So to get KEL, you simply get KEU minus KD which is down there. Then you multiply by 1, D over E, then 1 minus the tax rate. So that figure you simply add on KEU, then you get KEL. So that's now how, but there is already another formula I've given you. There's another formula I've given you that KEL, it is also earnings before interest and tax, subtract interest, then 1 minus the tax rate. You are dividing by the value of equity. So all of them will give you the same answer. All of them will give you the same answer. But now it will depend on the nature of the question and the information provided. But all of them will give you the same answer. We shall be confirming that when we get there. Then we can now add there another paragraph by noting that when MM incorporated the taxes, when MM incorporated the taxes, when MM incorporated the taxes, they concluded that in order to avoid, investors from practicing the arbitrage process, in order to avoid the investors from practicing the arbitrage process, comma, the difference in value of the two companies, the difference in value of the two companies will be equal to the present value, of the interest tax benefit, will be equal to the present value of the interest tax benefit. It will be equal to the present value of the interest tax benefit as follows. The present value of the interest tax benefit as follows. So when you want to get the value of the farm, so we require the lights or we continue like that. Lights. Are they affecting you? Because I think those who are online. So from there, now we can also have the formula for that, whereby value of the levered farm, should be equal to value of the unlevered farm. Value of the unlevered farm, then we add present value of the interest tax benefit. Then we add the present value of the interest tax benefit. The present value for the interest tax benefit. The present value for the interest tax benefit. So at online they are attacking Mangaza. They are saying they will see better without the lights. So that we use the natural lights. So that should now be able to give you, so to get the value of the levered farm should be given by value of unlevered, then we add present value of the interest tax benefit, the present value of the interest tax benefit. Then we add the present value of the interest tax benefit. So to compute the present value of the interest tax benefit, first we should come up with the interest tax benefit. So to compute the interest tax benefit, interest tax benefit will be given by the interest expenses. Interest expenses we multiply by the tax rate. We multiply by the tax rate. So to compute the interest tax benefit, we simply come up with the interest expenses. We multiply by the interest tax benefit. Then to get the interest, we simply take the debt. We multiply by the KD. KD is the interest rate. Then now we multiply by the tax rate. So to compute the interest, to get the interest tax benefit, we simply compute the interest expenses, which is given by the debt. KG is the interest rate. Then now we come up with the interest expense. Then now we multiply by the tax rate. And after that, we multiply by the tax rate. Then from that portion now, to compute now the present value. So present value of the interest tax benefit. The present value of the interest tax benefit, it will be the same as the annuity. The annuity divided by R. It will be the same as the annuity divided by R. So that annuity is the interest tax benefit. That annuity will be the interest tax benefit. Interest tax benefit. Then R is meant to be the cost of capital. R is meant to be the cost of capital. So to compute the present value of the interest tax benefit, we simply take the annuity, we divide by R. So that annuity is the interest tax benefit. Then we divide by the cost of capital. Then this interest tax benefit is the same as the debt multiplied by KD. Then we also multiply by the tax rate like that. Then now we divide by the cost of capital. Now we divide by the cost of capital. So this cost of capital for the debt, it is still the interest rate. The cost of the debt, it is still the interest rate. So we shall be dividing by KD like that. We shall also be able to divide by KD. So finally, these two KDs will be able to cancel off. Those two KDs will be able to cancel off, so that when we shall be computing the present value for the interest tax benefit, we simply take the debt multiplied by the tax rate. So finally, for us to come up with the present value of the interest tax benefit, we simply take the debt, we multiply by the tax rate. So that's now how we shall be computing the value for the levered farm. We simply get value for unlevered, then we add present value for the interest tax benefit, whereby we simply take the debt multiplied by the tax rate. So from there, we can now check some few questions on the M and M in relation to that. So the first question I want us to deal with, check the one for November 2016, question number 3. We check the one for November 2016, question number 3. We check November 2016. There is a question number 3. November 2016. Question number 3. So check on page 51. On page 51, you will get the question for November 2016. Question number 3, part B. Question number 3, part B. November 2016. There is a question number 3, part B. There is a question number 3, part B. So that question is about Manju Limited. It's just about to commence operations. It's just about to commence operations. Then they were also saying that operation as an international trading company. The firm would have a book value of the assets of 320 millions, and it expects to earn a 16% return on those assets. 16% return on those assets before interest and the tax. However, because of some tax arrangement with the foreign government, the company will not pay any tax. It is known that capitalization rate for an all-equity firm in the business is 12%. The company can borrow debt finance at a rate of 7% per annum. So the management is in the process. The management is in the process of deciding how to raise the required 10 million debt finance. Assume that Modigliani and Miller. Assumptions apply. So required using model without the tax. Determine Roma letter 1. Current value of the unlevered farm. Roma letter 2, current value of the levered farm. If it uses 10 million shillings of 7% debt. Roma letter 3, the weighted average cost of capital for the levered farm at a debt level of 7% if it has 10 million shillings. So that's now part B. But part C, when it comes to part C, it is still the same. Assuming that the company in part B above now pay taxes at a rate of 30%. They now pay taxes at a rate of 30%. Compute the following in the Modigliani and the Miller world. Roma letter 1, current value of the farm if it uses no debt. So if there is no debt, that farm is unlevered. Roma letter 2, if the current value for the farm, if it uses a debt level of 7%, shillings 10 million, that now it is levered. Then finally, WSEC. So let us start with the part B. We start off with part B when the farm is not paying the tax. We start off with part B when there is no corporate tax. When there is no corporate tax. So when there is no corporate tax, and want to compute the value of unlevered farm. So Roma letter 1, the farm is unlevered. So Roma letter 1, it is unlevered farm. So Roma letter 1, the farm is unlevered. So if the farm is unlevered, to compute the value of unlevered farm, it is the same as market value of equity. Market value of equity is the same as the market value of equity, which is supposed to be given by earnings before interest and tax. 1 minus the corporate tax. Then we divide by KEU, like that. So KEU is the cost of equity of the unlevered farm. When you want to compute the value of unlevered farm is the same as the market value of equity. That's the market value for the ordinary shares. So in this question, you compute earnings before interest and tax. It was not given. But when you go through the question in the first paragraph, they gave you net book value of the assets as 320 million. But they continued and said that it expects to earn what percent? 16% return on assets. So we get 16% of 320 million. We get 16% of 320 million for that. Because the question said that the farm will have a book value of the assets, which is 320 million. And it expects to earn 16% return on these assets before interest and tax. So our earnings before interest and tax will be 16% of 320 million, which is giving us around which year? It is giving us 51.2 million. So KEU was given. When you continue with the question, they had said that however, because of some tax arrangements with the foreign government, the company would not pay taxes. It is not that capitalization rate for an all equity firm. Capitalization rate for an all equity firm in the business is what percent? 12%. So our KEU is 12%, the cost of capital for the unlevered firm. So KEU has been given us 12%. So from there, we can now get the value of the unlevered firm. You simply take 51.2 million. So that from part B, they said without the tax. When you check that part B, they say that using MM model without the tax. So there is no tax to be paid for that. Then divide by 0.12 so that we now come up with the value of the unlevered farm. So that we come up with the value of the unlevered farm. So that should be able to give you the value of the unlevered farm. So it will give us around which figure? Sorry, 426.67. So that's now our Roman letter 1 for the farm when it is unlevered. So we also go to the Roman letter 2. We also check Roman letter 2. So Roman letter 2, they had explained that the current value of the levered farm, now the farm is levered. So Roman letter 2 is about levered farm. Roman letter 2 is about levered farm. So to compute the value for the levered farm, value of the levered farm is the same as the value of unlevered. We add present value interest tax benefit. So to compute the value of the levered, it is simply value for unlevered, then we add the present value of the interest tax benefit. Value for unlevered, you have just calculated. It was 426. It was 426, 600 and what? Sorry, 6.67 million. So you remember I gave you the formula for the present value for the interest tax benefit. You simply take the debt multiplied by what? The tax rate. But they have said without the tax. So when you go to the Roman letter 2, the debt is 10 million. So you are to take the 10 million, we multiplied by the tax rate, but now it is not there. They say without the tax. They say without the tax. So when there is no tax, value for the levered and unlevered will be the same. When there is no tax, the value for the levered and unlevered will be the same. So this will just remain 426.67 million. we just remain 426.67 million. Just giving that value. So when there is no taxes, there is no difference between the value for the delivered and undelivered. So that should be now our Roman letter 2. We go to the Roman letter 3, where you are to compute the weighted average cost of capital of the delivered farm at a debt level of 7%, shillings 10 million. So we go to Roman letter 3, where we compute the WSCC. We go to the Roman letter 2, where we calculate the WSCC. So to compute the WSCC, it is simply the weight of equity, cost of equity for the delivered farm. We also add the weight of the debt. So KD must always be after the tax. So to calculate our WSCC, it will be weight of equity multiplied by the cost of equity for the delivered farm, weight for the debt, KD, which must always be after the tax. So at this point, you need to get the weight for equity, also the weight for the debt. To get those weights, we say that value of the farm should be equal to value of equity. Then we add value of the debt. We add the value for the debt. So value of the farm, this is the farm when it was delivered. Value for the farm, it is 426. It is 426.67 million. So value for equity, you don't know. It must be the market value. But the value for the debt, it is the book value. The value for the debt, it is 10 million. So if the value for the debt is 10 million, what should it be? The value for equity at that point. So value for equity must always be the market value. But the debt should be the book value. The debt was given there, but the value for the farm is this. So what should it be? The value for equity at that point. What should now be the value for equity? So value for equity should be now how much? It's going to be 416.67 million. Then now after that, we need to calculate KEL. So I've given you two formulas on how to compute KEL. I've given you two formulas on how to come up with KEL. So I will confirm both, whether they will give you the same. So the first KEL, it is KEU, then we add in the brackets KEU minus KD, then D over E, then 1 minus the tax rate like that. So we shall be confirming both formulas, whether they will give you the same. So this is what we have created today, how to come up with the cost of equity for the undelivered farm. So KEU, we already know it is 12%. Then also 12%. KD is the interest rate. That KD is the interest rate, which is 7%. Like that. Then the weight for the debt, it is 10 million. The weight for equity is 416.67 million. So they say without the tax will simply be at 0. They say it without the tax. So they say it without the tax. So we confirm what value are we going to have at that point. Now pair 12 points. So you are getting 12.12. So we are confirming whether when we use the other formula, we shall get the same figure. You want to confirm when we use the other formula, but for the exam, we'll just be applying one of them. So the other formula was that KEL will be given by earnings before interest and tax. We subtract interest. Then 1 minus the tax rate. Then we divide by the value of equity. Value of equity, then show it as a percentage. Value of equity, then we show that figure as a percentage. So earnings before interest and tax we had already calculated. You remember 51.2 million. So we subtract interest. So to compute interest, the amount for the debt is 10 million. Interest rate is 7%. So what will be 7% of 10 million? The interest, the 7% of 10 million should be 0. What? It will be 0.7 million. So they had said there is no tax. Then value of equity is this 416. 416.67 million. Then show that figure as a percentage. We are only confirming that you will be using only one formula. Both of them will give you the same. Both of them will give you the same cost of equity for the levered farm. Both of them are going to give you the same value. So your figure itakuja ngapi? Sorry. It is 12.12. It should be 12.1. So just pick one of the formula and use. It will give you the same outcome. So now we compute our WSC. We should now be able to calculate our WSC. So to compute the WSC, now to come up with the WSC. So WSC will be equal to weight for equity. You take 416.67. Divide by the total value of the farm. It is 426.67 like that. Multiplied by KEL, which is 12.12. KEL is 12.12. Then we also add the weight for the debt is 10 million. We also divide by 426.67 million. So KD was 7%. But that 7% should be the after tax. But now they say there is no tax. There was no tax. So you just have it like that because there was no corporate tax. Because there was no corporate tax. So you figure about it about 12%, like what was initially there, KE. When there is no tax, WSEC is the same as KEU. So you confirm and see it will give you which figure. Now to pay 12%. Yeah, so when there is no tax, WSEC is the same as KEU, which was 12%. So that was part B, but now you want to go to part C, where they will now incorporate the taxes. We now check when they incorporated the taxes, what was the effect? So go to part C of the question. We now check part C. Under part C, they said that assuming that the company in part B above now pays the tax. The company in part B above now pays the tax at a rate of 30%. Compute the following in the M and M. So we are still repeating the same part of the question, but now there is corporate tax. We are now repeating the same, but for now there is the corporate tax. For now we have the corporate tax. We are simply repeating the same, but now there will be corporate tax. So we start with the Roman letter 1, where there is no debt. It means it is unlevered farm. But now there is tax. When there is tax, to compute the value of unlevered farm, it will be earnings before interest and tax. 1 minus the tax rate, we divide by KEU. So already we know our earnings before interest and tax. It was 51.2 million. Was it 51.2? Yeah, but now they have introduced a corporate tax of 40%. They have introduced a corporate tax of 30%. So 30% will be the same as 0.3. Then KEU is still 12%, which is 0.12. So that now will give you the value for the farm when there is corporate tax. That now should be able to give you the value for the farm when there is the corporate tax. When there is the corporate tax. So that will be Roman letter 1. So this one is giving us which period? 298 points. So that is now our Roman letter 1. So we got, are you getting that figure? Online, you are getting the same. So we go to Roman letter 2. Roman letter 2 is now levered farm. Roman letter 2 is now meant to be levered farm. So for the levered farm, value of the levered farm, it is supposed to be given by value of the unlevered. Then you add present value of the interest tax benefit. Then we add present value of the interest tax benefit. So value for unlevered, it is 298.67 million. 298.67 million. Then we add, so the debt was 10 million. The corporate tax is 30%, which is the same as 0.3. So that is now the value when the farm is levered. That now will give you the value when the farm is levered. That now should be able to give you the value when the farm is now levered. When the farm is levered. So that is Roman letter 2. Then we now finally go to the Roman letter 3. Roman letter 3, they were asking me to compute the WSC. Roman letter 3, we now come up with the WSC. It will simply be weight of equity, cost of equity for the levered farm, weight for the debt, KD, which must always be after the tax. But now at that point, start by getting the proportions, where we say that value of the farm should be equal to value of equity, we add value of the debt. We add value of the debt. So this value for the farm, you are getting which figure? 300 and what? It is 301.67. So value for equity, we have agreed is the market value. But value for the debt will be how much? 10 million. So what should be now your value for equity? Sorry? 291. So 291.6. Yeah. So now after that, you compute KEL. So far, now you just pick one of the formula. We just now pick one of the formula, whereby to get now our KEL, I will use the earnings before interest and tax, subtract interest, then 1 minus the tax rate, divide by value of equity. Value of equity, we show it as a percentage. Value of equity, we show it as a percentage. So, earnings before interest and tax, we already had it. You remember it was 51.2 million. Then you subtract interest. Interest, you remember it was how much? 0.7 million. 0.7 million. Then there is 1 minus 0.3, because now there is tax. Divide by the value for equity, which is now 291. 291.67 million. Then express that part as a percentage. Then we should be able to express that item. So 12.12. So once you get that, we can now compute the WSCC, because the question wanted you to come up with the WSCC. So now we can calculate the WSCC. So now to get our WSCC, so WSCC should be equal to. So weight for equity, it is 291.67. So we divide by the total, which is 301.67, multiplied by KEL, which is 12.12. Then we also add the weight for the debt will be 10 millions. The total is still 301.67. So KD is the interest rate, which is 7%, but this time there is tax. 1 minus 0.3 will be the same as 0.7. So multiplied by 0.7, because now there is tax. We multiplied by 0.7 because now there is tax. For now, there will be tax at that level. So, unapata 11 point loss. So now WSCC has gone down. When there is tax, there will be a difference. So the next question, we check May 2018, question 4, part B. May 2018, question number 4, part B. We go to May 2018, question number 4, part B. May 2018, question 4, part B. We check on page 40. When you go to page 40, there is May 2018, question number 4, part B. May 2018, question number 4, part B. May 2018, question 4, part B. So that is on page 14. So they were able to give us about Latat Limited unlevered farm operates in the textile industry. So the firm's current capital structure is summarized as follows. So they gave you ordinary share capital. The bar value has been given as 15 shillings per share. Total amount is 120 million. Total amount is meant to be 120 million. Share premium has also been given 40 million. Retained earnings, they gave you 80 million. Total shareholders' equity is 240 millions. Then the firm is considering borrowing 10% debt finance of 40 million shillings in order to finance an expansion program. In order to finance an expansion program, making it what? Levered. When it borrows, it becomes now a levered farm. So additional information, note number 1, annual earnings before interest and tax generated by the farm are 60 million. This is expected to remain constant each year in perpetuity. Note number 2, the firm's ordinary shares are currently trading at the market price per share of 200 at the Securities Exchange. Note number 3, the corporate tax rate applicable is 30%. So now required using Modigliani and the Miller approach and the information provided above, analyze the financial implication of the change in the capital structure of the firm. So they want you to analyze the financial implication for that. Then when you go to the Roman letter 2 on the next page, they were saying that using your answer, advise the management on whether to do it, to change the capital structure. So currently the firm is unlevered. That's now before they change. But when they change, the firm will become levered. The 2 items, not 2, that the 3 items for the analysis are the value of the firm, cost of equity, and WSEC. We compute both before and also after, so that we compare the 2. And the optimal capital structure was that it is where the value will be maximum, but WSEC should be minimum. That's now the optimal capital structure. So the simple concept in that question. First, we start with the value of the firm when it is unlevered, cost of equity when it is unlevered, WSEC also when it is unlevered. Then after that, we go to when it is levered. You see the Roman letter 1, 2, and 3 for the previous question. Those are the things you analyze. The value for the firm, cost of equity, and WSEC. That is when it is unlevered. Then we repeat the same when it is levered. Then we compare, then we make the decision on the basis of that. So we start with unlevered farm. We start off with the unlevered farm. So we start off with the unlevered farm. So the first concept is to analyze the unlevered farm. So unlevered farm is all equity finance. So the first item is to calculate the value of unlevered farm. So when the farm is unlevered, the value is the same as market value of equity. Market value of equity is the same as the market value for equity. So the other equation I gave you, it was earnings before interest and tax, 1 minus the tax divided by KEU. But this time round, the question has not given us KEU. Cost of equity for unlevered is not given. In that scenario, we cannot use the formula of earnings before interest and tax, then 1 minus the tax rate divided by KEU. When the KEU is not given, simply take the number of the ordinary shares. we just take the number of the ordinary shares multiplied by current market price per share, multiplied by current market price per share. So when you check in the capital structure, the question had given you that capital structure, ordinary share capital, you can see 120 millions. We take 120 millions. We divide by the bar value per share, which was given us 50. So this one is giving me the number of the ordinary shares. Then multiplied by the current market price per share in the note number 2. When you check over in the note number 2, the question gave you the current market price, that the firm's ordinary shares are currently trading at the market price per share of how much? So multiplied by 200. That now should be able to give you the value of the unlevered farm. Sorry? We get 480 millions. So that is now how to get the value for the farm. When there is no KEU, I cannot use the other formula. The only way, you simply take the number of the ordinary shares multiplied by the current market price per share. So Roman letter 3, you get the cost of equity. The cost of equity. So cost of equity will be now our KEU. The cost of equity is now our KEU because it is unlevered. So it will be given by earnings before interest and tax. Then 1 minus the tax rate. We divide by value of equity. We divide by the value of equity. Then we express it as a percentage. We divide by the value of equity. Then we express that figure as a percentage. We express that value as a percentage. So what are we given in the question as the earnings before interest and tax? So they gave you in the note number 1 as 60 millions. They were able to give you 60 millions. So corporate tax is 30%. The corporate tax is given as 30%. Then value of equity is now the same as the value for the farm. When the farm is unlevered, value for the farm is the same as the market value for equity. That means you divide by 480 millions. Then express it as a percentage. So when the farm is unlevered, the value for the farm is the same as K. This is the same as the value for equity. The value for the farm will be the same as the value for equity. So it will be able to give you around what percent? 8.75. So we get 8.75%. So that's now the Roman letter 2. We also need to compute the WSEC. We also need to compute the WSEC. But when the farm is unlevered, WSEC is the same as KEU. So this is already calculated. It will just remain 8.75%. When the farm is unlevered, WSEC is the same as the cost of equity of that unlevered farm, simply because there is no debt. There is no debt. So we have analyzed when the farm was unlevered. So we should now repeat the same when the farm is levered. We should now be able to repeat the same when the farm is levered. Then after that, we make the decision on the basis of the information provided. So let us now check when the farm is levered. We now check when the farm is levered. So we now go to the levered farm. So we should now be able to check when the farm is delivered. So when we change the capital structure, the farm now will be delivered farm. We have the delivered farm. We start again with the value for the delivered farm. So value of the delivered farm. Value for the delivered farm should be given by value of the undelivered, then you add present value of the interest tax benefit. Then we add present value for the interest tax benefit. Value for undelivered, you see, is 480 million. Then we add. So they are borrowing how much in the question? They were borrowing 40 million to make it delivered. So it is the debt multiplied by the corporate tax. This part is the same as the debt, which is 40 million. The tax is 30%. We multiply by 0.3 to give you now that portion. So that is now the value of the farm when it is delivered. So then we get 492 million. So that will give you 492 million. So once you have that, we now also go to the cost of equity. We also compute now the cost of equity. So cost of equity is now KEL. So KEL, it is supposed to be given by earnings before interest and tax. You subtract interest. You subtract interest, then 1 minus the tax rate. Then we divide by value of equity. Value of equity. Then we show it as a percentage. But now we need to come up with that presentation whereby we say that value of the farm should be equal to value of equity. We add value of the debt. So we add value of the debt. So value of the farm will be equal to value of equity. We add value for the debt. So value for the farm, it is 492 million. Then value for equity, we don't know the figure. But value for the debt is how much? It is 40 million. The value for the debt is meant to be 40 million. So what will be the value for equity? It is 454 million. 452 million. So now we get our KEL. So KEL should now be given by earnings before interest and tax. It was given to you as 60 million. So interest, to come up with the interest, the debt is 40 million. The interest rate of the debt is given as what percent? So what is 10% of 40 millions? In a 4 millions. So we minus 4 millions, then 1 minus the corporate tax, which is 0.3. We divide by the value for equity. Value for equity is now 452 millions. 452 millions. Then express that as a percentage. It's 452 millions. We shall now be required to express that value as a percentage. And after which percent? 8.67. So we are getting 8.67. So that is now the cost of equity. Then finally, we compute the WACC. So once we have the cost of equity, we should now compute the WSCC. We need to come up with what is supposed to be the WSCC. So WSCC, we now calculate the WSCC, whereby we take the weight of equity, cost of equity for the delivered farm, weight of the debt, KD, which must always be after the tax. So weight for equity, you simply take 452 millions, divide by the total value, which is 492 millions, multiplied by KEL. You have said is 8.67. Then we add weight for the debt. You take 40 millions, divide by the total, which is 492 millions. So interest rate was 10%. KD was 10%, but more by 0.7 again, because it is not after the tax, because it is meant to be after the tax. So we come up with those figures, then we make a comparison when it was unlevered and when it is levered, so that we advise whether to change the capital structure or not. So that we advise whether to change the capital structure or not. So we now compare. So we are only comparing two items, the value and the WSCC. We are comparing the two items, the value and the WSCC. So check the value when it is levered and unlevered. Which one is higher? The value. When you compare the value, when it is levered and unlevered, the value is higher when the farm is, when it is levered, isn't it? Then for WSCC, we pick the one which is lower. So when is the WSCC lower, levered or unlevered? Unlevered. Levered. So remember, the optimal capital structure is where the value is maximum. WSCC is minimum. So you see, when we change, value will increase. WSCC has done what? Reduced. So that's now why we should change, because it will lead to a higher value and a reduced WSCC. Remember, WSCC is the cost. The lower the cost, the less risky the project is. So we now use that to advise in the Roma letter 2. Roma letter 2, we advise them that the optimal capital structure, is where the value is maximum. The optimal capital structure is where the value is maximum, and WSCC is minimum, and WSCC is minimum. And WSCC is minimum. So we are saying that the optimal capital structure is where the value is maximum and WSCC is what? Minimum. Therefore, it should change the capital structure. Therefore, it should change the capital structure. Therefore, it should change the capital structure. It should change the capital structure as it will lead to increase in the value, and a decrease in the WSCC. It will lead to an increase in the value and a decrease in the WSCC. So you simply compare those two items. We compare the value and the WSCC, and the optimal capital structure is where the value is maximum and WSCC is minimum. So that was now the Roman letter 2, how to advise. So we get another question, May 2019, Question 4, still part B. Also May 2019. We also check May 2019. We go to May 2019. So we check May 2019. Question number 4. May 2019, question 4, part B. So you check that on page 29. You check that on page 29. Page 29, there is a question for May 2019. May 2019, question number 4, part B. Question 4, part B. So when you check on that page 29, you are given details about Zion Limited, Unlivered Farm. It is Unlivered Farm, has an in issue 10 million ordinary shares that are currently selling at the Securities Exchange for 20 shillings. That are currently selling in the Securities Exchange at 20 shillings each. Additional information, note number 1. The farm's most recent earning per share was 4 shillings, and it adopts 100% dividend payout ratio. It adopts 100% dividend payout ratio. Then, note number 2, it is expected that the farm future dividend in each year will remain constant in perpetuity. Note number 3, the farm is considering to issue 12% new debentures to raise shillings 50 million in order to finance an expansion program. This will effectively change the status of the farm from unlevered to levered. So the farm will pay the tax at a rate of 30%. So now required, using Modigliani and the Miller proposition, determine Roman letter 1, cost of equity before and after issue of the long-term debt. So before it is KEU, because it is unlevered. After it is KEL, because it is what? Levered. So in that Roman letter 1, they want you to compute KEU and also KEL. So they are asking you to get cost of equity before. So before it is unlevered. Then after it is what? Levered. Roman letter 2, the weighted average cost of capital before and also after. So they want you to get the WSCC when it is unlevered, also WSCC when it is levered. Finally, Roman letter 3, so the market value before, that's the value for the unlevered. Then also after, that's now when it is levered. Then finally, they are asking you to advise whether to do what? To change the capital structure. So the way the question is presented, it will not be easily be computed. What you do, you divide the question into 2, unlevered and levered. Solve all those items under unlevered. Then go to when it is levered. When you mix them, it will not work out. When you mix them, it will not work the way they have asked. So what you do, start with when the farm is unlevered, compute all of them up to the end. Then go to the farm when it is what? Levered. You also do all the same. Then the way they have structured the question, you cannot answer Roman letter 1 unless you have done Roman letter 3. We start with the value first. So you must start with the Roman letter 3. Get the value for the farm. You see what we have done in this question? You start with the value, you got the cost of equity, then you got the WSCC. So the way it is presented and the way it is asked, if you answer it that way, it will not work out. You must start with the value, which is the Roman letter 3. Then go to the cost of equity, which is Roman letter 1. Then finally go to the WSCC, which is the Roman letter 2. So divide the question into unlevered, you get the value, you get KEU, get WSCC. Then go to the farm when it is levered, also get the value, get KEL, then finally what? WSCC. Then it is obvious the advice would be change the capital structure. When the farm is levered, the value will go up. WSCC will do what? Will reduce. So that's now the obvious answer in the Roman letter 4. They must change the capital structure because once the farm becomes levered, the value will increase, but WSCC will do what? Will decrease. Then in that question, you are not given earnings before interest and tax. So you also need to do the working for that to get earnings before interest and tax. So to compute the earnings before interest and tax, we come up with this format. So in answering that question, you need to compute earnings before interest and tax. You need to compute earnings before interest and tax. So earnings before interest and tax, I'll just give you the structure how it's normally presented. Then we answer that. So they normally start with earnings before interest and tax. We can have the value at that point. Then we normally less interest. We normally subtract interest. When you subtract interest, you get the value at that point. So that we come up with the earnings before the tax, like that. Then we normally less the tax, like that. So that less the tax, so that we come up with the earnings after the tax at that point. So that we come up with the earnings after the tax. So that's now the structure that will assist us to go and compute the earnings before interest and tax. So these earnings after tax, this part of the earnings after the tax, we simply take the number of the ordinary shares. Number of ordinary shares, this part, it is simply number of the shares. Number of the shares multiplied by earning per share. So to get the earnings after tax, simply take the number of the shares multiplied by what? Earning per share. That's now to be your earnings after the tax. Earning per share is after the tax. But now, to get the total earnings, simply take the earning per share multiplied by what? The number of the ordinary shares. So the question gave you all those details. Are you able to see the earning per share in the note number 1? Note 1. What is the earning per share? Tumepewa 4 shillings. Then in the first paragraph, you can see how many number of ordinary shares they issued. 10 million ordinary shares. I hope you can see that part. So when we multiply, what should be our earnings after tax? Inakuja how much? 40 millions. Then we know the tax is 30%, isn't it? So if the tax is 30%, because the tax must be 30%, which means that this item is 70%, like that. Which will mean that our 40 million is equivalent to 70%. So how about 30%? You work backwards. So if 70% is what we give you, 40 millions. How about 30%? It should give us which figure. We cross multiply. We cross multiply so that we get the earnings. So that we get the tax. So that we come up with the tax. So when you cross multiply 40 million multiplied by 30% divided by 70%, itakuja ngapi? Sorry. Not just 17. 17.4. 1.4 million like that. So we are moving backwards. So to get rid of June, what should be now our earnings before the tax? So you just add this plus this to make that, because this minus this is what will give me this. So now to go back, this plus that now in this here. So 17.14 plus 40 million. That should be able to give us which figure? 50. 57.1. 14 million. Then the farm, by then it was unlevered. So remember, the farm was unlevered at that time. Interest will be 0. Interest is 0 because the farm was what? Unlevered. So that means our earnings before interest and tax should be 57.14 million. So you are to go that direction for you to come up with the earnings before interest and the tax. So now after that, we start with when the farm is unlevered. We now start with when the farm is unlevered. So when the farm is unlevered, we now want to check when the farm is unlevered. We now analyze when the farm is unlevered. So when the farm is unlevered, so you want to start with the unlevered farm. Unlevered farm. So we say that we start with the value of the farm. We start off with value of the farm. Value of the farm. So value of the unlevered farm is supposed to be given by earnings before interest and tax. So, sorry, this one, we shall still use the market value of equity. Or still we can use the same. So we already have it, but we don't have the cost of equity. Sorry. Atuna KEU, so we still use the number of the shares. It's the same as market value of equity. Market value of equity, which will be the number of the shares. Number of shares multiplied by the current market price per share. So we simply come up with the number of the shares multiplied by the current market price per share. So number of the ordinary shares are 10 million. You can see in the first paragraph, and they are currently selling at how much in the securities exchange? 20. So it is 10 millions multiplied by 20. 10 millions multiplied by 20, which should be able to give us around, we get 400. We get 200 millions. So that is now our value for the farm. So we go to Roman letter 2, where we get the cost of equity. We get now the cost of equity. So cost of equity is KEU. Cost of equity is meant to be KEU. So that KEU is supposed to be given by earnings before interest and tax, 1 minus the tax rate, you divide by the value of equity, then you show that as a percentage. You show that portion as a percentage. So what are we getting as our earnings before interest and tax? 57.1 million. 1.4. Then corporate tax is given as 30%. So value for equity is the same as the value of the farm, which is 200 millions. Then show that as a percentage. Then we show that value as a percentage. Show that as a percentage. So it is giving you which percent? Sorry? So when you have option B, inakuja 20%.
Yes.
So that's now our cost of equity. Then we still also compute the WSC. So when the farm is unlevered, we say WSC is the same as what? KEU. So it will just remain 20%. So when the farm is unlevered, the cost of equity will be the same as the W. The WS is the same as the cost of equity. That's now when it is unlevered. So from the question perspective, when you answer your cost of equity, then WSC. The value. So there is no way utapata cost of equity of the WSC unless you have that much calculated the value. So even if it is structured that way, you should now have the concept that you start with the value, go to the cost of equity, then WSC. That should be the order. So we have done when it is unlevered. We also do the same when it is levered, so that we now advise whether to change the capital structure or not. So let us now check when the farm is levered, because when you change the capital structure, it will now become a levered farm. It will now be a levered farm. So now let us check when the farm is levered. Now also analyze for the levered farm. Levered farm. Now also check when the farm is levered. So when the farm is levered, the first thing we say, we get the value of the farm. Value of the farm. So value of the levered farm, it is value for unlevered. We add present value interest tax benefit. So you already have the value for unlevered. It was 200 millions.
Yes.
So we take the 200 millions. So how much were they borrowing to make it levered? They were supposed to borrow. So they want to borrow 50 million. That is in the note number 3. So you take the 50 millions multiplied by the corporate tax. And the corporate tax is what percent? Yeah. So what can calculate the value? The value, the present value of the interest tax benefit, you simply take the debt multiplied by the tax rate. You simply take the debt multiplied by the tax rate. Value itakuja ngapi? 215. So after that, remember we go to cost of equity. So the next item is to calculate cost of equity. So to get the cost of equity, first get the value for the farm at that point, where we say that value of the farm should be equal to value of equity, then we add value of the debt. We add the value for the debt. So Value of the farm is 215 million. Value for equity must be the market value. Value for the debt is 50 million. Inakuja 100 and get 165. Then now to compute cost of equity is our KEL. Cost of equity is KEL, which should be given by earnings before interest and tax, subtract interest, then 1 minus the tax rate. Divide by value of equity. Value of equity. Then show that figure as a percentage. Show that value as a percentage. So we had calculated our earnings before interest and tax. The profit was 57.14. So interest, get the interest. Interest rate is interest rate to repay which percent? What is 12% or 50 millions? Inakuja 6 millions. So we subtract interest of the 6 millions. So 1 minus 0.3. We divide by the value for equity, which is 100 and what? Then it's also going to express it as a percentage. We have to try which bag. Sorry. It's not better. We are getting which percent? 21.7. Yeah, I've seen 21.7. So then after that, now we also compute WSC. So finally, we got the WSC. We now also compute the WSC. So the WSC should be, now we also compute the WSC. Weight of equity, cost of equity for the levered. Weight of the debt. So KT must always be after the tax. KT must always be after the tax. So someone is asking, the question is not the value of the debt supposed to be 63.14? 63.14 if we are considering the formula of calculating which value? For calculating the earnings before interest and tax. So Anauliza kama the value of equity is supposed to be, so value of the earnings before interest and tax, whether it is supposed to be 63.14 if we are considering the formula for calculating the earnings before interest and tax. So how did you get 63.14? How did you get the 63.14? So 57, 114, then is 6 million. That one you have not factored in the tax. The question has the tax. Hiyo swali iko na tax. So if you are doing that, then you have not factored in the tax. Naona tax yetu iko nje. So what you have done there, if you do that way, you have not taxed to get that cost of capital. So it will not work that way. That 57.14 is before the tax. So if you take that figure and add 6 million, then that will not be the correct way of computing the value. But why should you go that direction? Because we started when everything else is not available. We started when everything else is not available. The 6 million has come in when the farm is levered. All those details that you are given, the farm was what? Unlevered. So don't put the 6 million at that point, because when we calculated 57.14, the farm was what? Unlevered. That was meant to be when the farm is unlevered. So it will not work that way. Then I'm also wondering, why should you add the 6 million on the 57.14? What is the 6 million? Is the interest. So why should you add in the first place? Why should you add 6 million in the first place? Because earning per share was given when the farm was unlevered. Your information tumeambiwa that zone limited is what? Unlevered. So when it is unlevered, the farm has 10 million ordinary shares. So the 10 million I used was when the farm was unlevered. Yeah, anataka tupate 24.24%. So anasema hii value for equity. Yeah. If you want to go that direction, ukuje tena uadjust hiyo. Your question is ambiguous. It is wasting my time. I will not address it because the concept is very simple. The concept is very simple. But I had explained to her, when you are using 57.14, the interest was 0. There was no interest. When you are getting 57.14, there was no interest. Then to get the value for the levered, it is value for unlevered plus what? Present value, interest, tax benefit. So if you want that, remove this. But how would we get this when we are still using this? If you want to get the 63, so that means that we should not include this one. So let us finish the question. We answer it later because we only the figures are happy. So WSEC should be the weight for equity is 165 millions. We divide by what? It was 215. So KEL should be which figure? 21.7. Then the weight for the debt should be what? Then we also divide by what? So KD is now the interest rate, which is which value? It was 10%. 12. So also multiplied by 0.7. Then we come up with the value for it. Sarah? 18.61. Ukiandika tu hivyo, this is already a percentage because these figures are already percentages. So yes, yeah, even through someone will be able, because the key issue is your presentation. So finally, at that level, that's not omission. So should we change the capital structure or we should not change the capital structure? You compare before and after. We compare before and after. So when it was unlevered, the value was, then when it became levered, the value increased to, then also WSEC. When you check the WSEC, when it is unlevered, so WSEC has reduced, isn't it? Yeah. So that now we go to the Roman letter 2, where you are to add Roman letter 4, where you are to advise. That advise the management on whether to change its capital structure. They want you to advise the management on whether to change the capital structure. So we can say that it should change the capital structure. It should change the capital structure. It should change the capital structure because it will lead to, an increase in the value. It will lead to an increase in the value. It will lead to an increase in the value and a decrease in the WSEC. And a decrease in the WSEC, and a decrease in the WSEC. So that was now the concept on the question. So I still want to advise that person who was trying to give it 63. The question was given when the farm was unlevered. That is the standard measure. Get the earnings before interest and tax when the farm was unlevered. Then in the notes, we noted that the difference between the unlevered and levered is present value of the interest tax benefit. So that is now what we change the value. So after changing the value, earnings before interest and tax will remain the same because we are using M and M. So don't increase the value of the earnings before interest and tax after the firm is levered. We are simply changing the capital structure after we propose to borrow. So if you are proposing to borrow, you have not borrowed. You have not borrowed. So don't include there the way you have presented to get your earnings before interest and the tax. So earnings before interest and tax that you should use should be the one that was there when the firm was unlevered. They were only considering to borrow. So don't add there your 6 million because the company has not borrowed. They are only proposing to borrow. So if they propose to borrow, you should use the same earnings before interest and tax that were there to add there the present value for the interest tax benefit. So that's now in relation to that portion of. That's now in relation to that portion of what we have there. So maybe alikuwa anatumia KE. Even when you use KE, you will still get the same. When you use KE, you will still get 20%, then you increase it. You remember KE is supposed to be what? Yeah, maybe you want to tell something there. You remember KE, it was P divided by PO minus what? The flotation cost, then you express it as what? A percentage. Alikuwa anapata 24 points. So to get KE, it is supposed to be that portion when you are using the capital structure. So the question had given you the earning per share. Are you able to see the earning per share? So dividend per share is supposed to be given by earning per share multiplied by dividend payout ratio. Dividend payout ratio. So when you apply that, and because the dividend was paid at 100%, the question has said that they are paying dividend at what percent? The firm will adopt 100% dividend payout ratio. You see, they're not number one. So if they adopt 100% dividend payout ratio, it means that the dividend will still remain how much? The same as the earning per share, which was given as how much? 4. So divide by the current market price per share, which is supposed to be which figure? 20. There was no flotation cost. So express it. So this one is the same as your KEU, because the firm is what? Unlevered. So to get KEL, I gave you the formula that KEL should be given by KEU plus KEU minus KD. Then T over E, then 1 minus what? This is the one for Modigliani and Miller. This is for Modigliani and Miller. So confirm it using this formula. It will not lead you to 24 point something. It will go down. Then also, when the firm is levered, that KEL will definitely go down from that perspective. So we can stop there. When we meet, we shall be having a subtopic as MM model of incorporating the bankruptcy and the agency costs. So when we meet, we shall start a subtopic as MM model of incorporating the bankruptcy and the agency costs. MM model of incorporating the bankruptcy and agency costs. The MM model for incorporating the bankruptcy and agency costs. So I will give you an assignment from what we have done. So you will do an assignment for November 2015. November 2015, question number 3, part B. You will check November 2015, question number 3, part B. November 2015, question number 3, part B. So we can stop there. When we meet, we shall now proceed from that level.